On to proof number 2. Proof number says that over the long term, markets have gone up. So buy quality and retire comfortably. How many would agree with that statement? How many people? Can I get a raise of hands? How many people? Come on, raise your hands. Come on, we all learned this. Come on. Over the long term, markets go up. Come on, help me out here, guys. Yes, everybody. Come on, raise your hands. Of course. Of course. It's a true statement, right? In fact, let's look at an advertisement by Vanguard. And I got this off the internet, which I thought was great. There's always been periods of volatility. The 87 crash, I was a young person in 87, and younger than you guys. And the interesting thing was, I remember that day. But you can see that market's short term, but over the long term, if you take a long-term view, then you'll retire comfortably, because over the long term, markets go up. Okay, makes sense. In fact, if you looked at any newspaper in the United States, what do? They may publish the Dow Jones from 1913 to, it's not quite updated to, in this case, 2010. But you can see that the market over the long term does go up. Okay, you were all right. Congratulations. But there's one small problem with this chart. This chart is priced in US dollars. Now, I got to tell you, a dollar in 1913 bought a lot more than a dollar does today. Okay, a dollar in 1913 might have been able to buy this suit. Now this suit cost me about $10 at the thrift savings store, so no, I'm kidding. The bottom line is that a dollar could have bought a really nice Brooks Brothers suit in 1913, and today you could buy a pack of gum. So if we adjust the growth of your money and we nominalize it in real dollars, the chart looks in real dollars, from a nominal dollars, and we adjust the value of money, what we find is that real dollars, the market has not gone straight up. In real dollars, the market has gone through ups and down cycles. Well, because think about what money is. It's just what money can buy. Money is just a transfer, right? It's just a transfer tool. And the bottom line is, yes, if you would have bought the market in 1982, you'd have done extremely well by 2000. You had about 16, 17 years of a secular bull market. And the same thing, after World War II, we had an explosion of the markets after World War II. And the U.S. was sort of the king of the world, and the rest of the world was destroyed, and we were selling products globally and did very, very well. But the point is that if you would have bought the market, if your grandparents or great-grandparents would have bought the market in 1966, the problem is that they probably wouldn't have done very well. In fact, your great-great-grandfather probably doesn't have a lot of good things to say about the market, because all he remembers is, in real dollars, he lost a ton of money. And it would have taken you 28 years, or till 1994 in real dollars, to get your money back. That's 28 years of a lot of buying, hoping, and holding. That's interesting. So the truth is that over the long term, markets have not gone up. What newspapers should be doing is quoting the markets in real dollars. But they don't do that, because that doesn't sell investments. The second part of the equation is don't worry about systematic risk. Doc and I were talking about systematic risk earlier. And it's interesting because if we look at the different types of risk, and it's interesting to look at various types of risk, and as a finance club, an investment club, I'm sure that many people in this room have learned about these types of risk. Let's talk about what we mean by systematic risk. And so let's kind of just for a second here look at what idiosyncratic risk is.
Great job. All right, anyway. Okay, Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine. Do not take your money out. This is really, look, if there's one takeaway other than a plus 400 something, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly. Don't be silly. Bear money's back after the break.
Okay, so Jim didn't do a very good job on that one. The interesting thing is that's idiosyncratic risk. Idiosyncratic risk is stock-specific risk. It's risk that Bear Stearns, which actually led to other types of risk. And then we have systematic risk, And let's look at systematic
risk. What is
risk.
the worst case scenario? So we have so many economists coming on our air and saying, oh, this is a bubble and it's going to burst and this is going to be a real issue for the economy. Some say it could even cause a recession at some point. What is the worst case scenario if, in fact, we were to see prices come down substantially across the country?
Well, I guess I don't buy your premise. It's a pretty unlikely possibility. We've never had a decline in house prices at a nationwide basis. So what I think is more likely is that house prices will slow, maybe stabilize, might slow consumption spending a bit. I don't think it's going to drive the economy too far from its full employment path, though.
So would you agree with Alan Greenspan's comments recently that we've got some areas of the country that are seeing froth, not necessarily a national situation, but certainly froth in some areas?
You can see some types of speculation, investors turning over condos quickly. So those sorts of things you see in some local areas. I'm hopeful that, and I'm confident, in fact, that the bank regulators will pay close attention to the kinds of loans that are being made, making sure that underwriting is done right. But I do think that this is mostly a localized problem and not something that's going to affect the national economy.
Okay, so no systematic risk in the real estate market. Was he right? Well, he was 100% wrong. There was systematic risk, something that affects the system. So let's take a look at Lehman Brothers. Lehman Brothers collapsed. And that was idiosyncratic risk. Idiosyncratic risk led to a systematic problem. The banks, and we'll get into, of course, the problems with the CDOs and what was going on there. And then, of course, that led to market risk. And, of course, the stock market just collapsed. And that was October of '08. So the bottom line is that the problem, and I mentioned this to Doc, I said the problem is that a lot of fund managers, a lot of Wall Street doesn't really address systematic risk. Their approach is long-term, we're fine. Well, let's just look at the last two downward moves. Since March of 24th, which was the peak prior to the dot-com bubble, and then, of course, the credit crisis. Let's take a look at that. And this was just last week. It's amazing how this market has had such a week that it's had. But if we adjust this over 14 years for the value of money like we just did with the Dow from 1913, what we find is that in the market at 1950 is essentially the market right now is like it's at 1403. So in other words, we are underwater. That's 14 years of no growth, 14 years of no compound interest, if you will. In fact, what's interesting is there's a website called shadowstats.com, and what shadowstats.com does, see, during the Clinton administration, they changed the CPI, the Consumer Price Index. And they did that for a lot of reasons, mostly because the Social Security is indexed to inflation. And Social Security is an entitlement program that you hear a lot of politicians talk about. So if I want to slow the growth of that entitlement, I could play with my CPI numbers, and I could start changing the way I calculate the CPI. And what Shadow Stats does is they say, okay, I'm going to continue to calculate the inflation rate based on the way we did it prior to the Clinton administration playing with the numbers and the funny numbers. And so at the market where it is today, you can see that it's actually way below where the market was in 2000. So how could you not address systematic risk? You know, it's funny, my neighbor came down my driveway about a week and a half ago. Now, I'm sure everybody in this room know what happened in the markets in early October. They just started to really collapse. And he said to me, he goes, oh my God, I'm sure you've been busy. He knows what I do. And I said, well, you know, we actually like volatility, the way we run money. And he goes, well, you know, it's a little scary looking at my 401k, but I don't worry about that because I'm invested in the long term in my 401k. And I laughed. And he says, why are you laughing? And I thought I didn't want to ruin his Sunday, you know, so I said, what do you think? The Broncos are going to win? I changed the subject. But the truth is that, you know, let's assume he's going along 40 years, he accumulates $1 million, and then he has a systematic event like what we've seen over the last 14 years. He can't retire when his $1 million is down to $500,000, and him and his wife are used to a lifestyle where he's making 5 or 6% on that money. So systematic risk is something that needs to be addressed in the financial community. It's not. So over the long term, markets don't go up and systematic risk is something that can destroy wealth because of negative compound interest. One of my favorite, I have many favorite quotes, as my interns know, as my students know. We have cups. We should have brought the cups here, Patrick, with all these quotes. It's not what you think you know that will hurt you. It's what you don't know. That's not so. So anyway, I would say proof number 2 is proven wrong. Okay, let's go to proof number 3. The best way to achieve financial success is with a well-diversified portfolio. Now, come on. This has got to be true, right? Come on. Give me your hands here. Come on, guys. Everybody knows that this is the secret to wealth. Come on. All right, well, let's take a look at this.